What is good, YouTube? It is your boy Sam, and I am back with another video. We've been consistent, so make sure you follow on this journey. You subscribe, you like, you comment, and you share. Okay, I got some good news. I got my first comment the other day, so shout out to you. I appreciate the feedback, and so I can see the community is growing slowly but surely. Okay, so in today's topic, we will be discussing revenge trading. Yes. Now, I know some of you guys are familiar with this term. Some of you guys don't know what revenge trading is. I did briefly mention it in previous videos, and I said I would make a whole separate video on it. And so here we are. Okay. So what is revenge trading? It's pretty self-explanatory, but that's okay. Revenge trading is basically when you've made a bad trade, lost some money, and in order to compensate for that, you decide to make another trade again, right? It's kind of like someone playing at the casino and losing at the casino, okay? And I hate to bring up the casino because a lot of people like to think of trading stocks as gambling. Trading stocks is not gambling. It can be, however, how we do things is not by way of gambling. And this is why I bring this video to you now, because revenge trading can be considered gambling, I guess, or I look at it as gambling. So I guess I can see why some people say that. But if you have discipline, you set rules for yourself, you can pretty much get yourself out of that category and look at yourself as a responsible investor. Okay. Now, I mentioned boundaries, I mentioned rules. We'll touch a little bit on that in this video as well. And of course, right, I do plan on making more videos on that as well. So make sure you stay tuned, you lock in, okay? So typically, revenge trading, there's a lot of emotion behind that, okay? And I mean, could you blame someone, especially if you don't know better? Because I used to revenge trade as well before I even knew that was an actual term, actual thing, okay? Because basically I would trade stocks, and because I would learn by ways of problems and trials, which is honestly the best way of learning, by just doing it, okay, you're gonna lose money. And that could be a bad thing because you're losing money, but it could also be looked at as a good thing as well, because just look at it as a paid lesson. Now, I know some of you may think that sounds kind of crazy, but it's not crazy at all. That's just kind of how you should look at it. Look at it as a paid lesson. If it impacts you that much, you will make sure that you don't make that same mistake again. And that's what's going to make you a better trader the next day than you were today or the day before. Okay, so a lot of expensive lessons when it comes to trading. And that is also why many of you guys may not want to hear this, but when you trade, and I don't want to lose you, okay? You guys lock in. Okay? When you trade, you have to be willing to lose everything that you're putting into that trade. Okay? If you're not in that mindset, you need to get in that mindset. Okay? And that will also protect you in making sure you do not put too much eggs in one basket. So, for example, you wouldn't want to sell your car, right, to get capital to invest it, and now you just don't have a car and you can't afford another car, if that makes sense. Okay, because what you're putting in there, you have to be willing to lose all of it. And that also goes for bills as well. Okay, don't take your bill money and trying to put it in the stock market so you could double or triple your money so you can pay your bills later. Okay, we can use profits we get from the stock market to pay our bills later on down the line, but you do not want to take your bill money and trade that to try and get some type of capital, no matter how tempting that can be. Okay, and as we set rules and boundaries as we go along this journey, you will become more comfortable with trading, and you can prevent yourself from having regrets, because when we trade, we shouldn't have any regrets. And out of that is much easier said than done. But once we engrave that in our brains, we can move less emotionally and more logically and use the mathematical patterns and equations that we have established for ourselves in order to get to the next level and see some good solid returns. Okay, so back in the day when I started trading at the age of 18, once it was legal for me to trade. Well, I was trading before that. I used Market Watch. So Market Watch, if you go to marketwatch.com, they have a simulation demo kind of thing. It's called paper trading. I know you guys are familiar with paper trading, where you get paper money or fake money, and it essentially mimics the market. So you could make moves that you would make in real life without having to use your real funds. That way you could get a good feel of how the market is trading, how it's going to affect the moves that you made, and you can better on analyze to see if you made that good move or not, essentially, right? So highly recommend going on marketwatch.com. Don't get too stuck in trading paper money, because like I said, the best way to learn is by actually doing it. And even though it's very similar, there's something different about trading your actual money versus trading paper money, right? Because we have a subconscious mind. Everyone has a subconscious mind. And so that's going to take control. It's going to try to protect you when you have your real money, which is fine. That is very natural, right? But that is why you consciously make sure you educate yourselves and gain the knowledge so that your subconscious could relax and align with what you've learned. Okay, so with that being said, get on Market Watch, try it out just to get a feel, just to get a good idea. And once you made a couple of trades and you feel like you're a little bit comfortable, now you can start going over to real money and making sure that whatever it is that you're investing is not going to hurt you if you were to lose all of it. Okay, so a perfect analogy for this would be, and I've mentioned this before, right? So let's just say you are a moderate drinker and you often go to bars and lounges and you spend, I don't know, $100 at the bar. You can take that money instead of, spending it at the bar and investing it into the stock market. That way, if you lose $100, you don't have to think about it like, oh my God, I lost $100. No, look at it as you've made an investment, right? Unfortunately, you were red on the investment, okay? And you're gonna take that, you're gonna learn with it so you can be green on the investment in the future, right? That $100 went towards potentially getting you more capital and 100% giving you more knowledge, as opposed to, let's say, blowing it at the bar. And nothing against the bar, guys, right? It's just an example, just so you guys can get a good understanding of something that you would want to take money out of that you may have used for something else, such as going to the bar and investing it into the stock market, right? But don't go taking away or not paying your credit card bills or your electricity bill or your water bill because you think you could double your money and now you're trading money that you need for the stock market, right? That is not what we're going to do. And that is also why I mentioned in previous videos, it is important to use apps such as the Acorns app, where it rounds up money that you use in your checkings account and it automatically invests it for you, or it automatically deposits it in an account for you to where that money compiles. And later on, when you go down later on when you go open up that app or look at that account for quite some time, you can see there's a substantial amount of capital that has built over time that you didn't even feel. Okay, it's kind of like when you buy something and some taxes come out of it, right? Like you don't really, I don't want to say you don't feel it, right? But it's not something that you might pay attention to too much. It's just something that's kind of expected, right? So make that an expectation. Okay, make sure you set yourself up so that you have reoccurring deposits going into your portfolio. And so that way, if you don't see a perfect window for you to just take X amount of capital to invest, you could just kind of have it, residually compound so that you can, use that for the future, right? But back on the specific topic on revenge trading. Okay, so let's say you purchase a stock, right, at, I like to use the standard $100, right? You purchase a share at $100. You think it's going to go to 110, and the stock goes to $80. So now you're in a panic. You're down 20%. You're thinking, oh my God, how do I get out of this? What you're not going to do is sell it. We talked about this before. So a lot of people would just sell that stock, get out of it, cut their losses. And, you know, if you don't know any better, that might be the reasonable thing to do, right? Stop the problem, stop the clock, and just kind of get out of there. But later on down the road, and as you've been watching my videos, you'll learn the best thing to probably do is just bring down your cost basis, buy some more, right? You could buy another share at $80. So now your cost basis is $90 because you initially purchased it at $100, and you put another share at $80, and now you're at $90. And all you need to do is hang on to it. Once the stock goes above $90, you're already in the green, as opposed to it going all the way up to $100. Okay, I know that was a lot, but now you know. Now, when it comes to revenge trading, typically what a revenge trader would do, and I don't mean to title someone who revenge trade as a revenge trader, right? Because just because you do something a couple times doesn't necessarily make you that, okay? But you don't want that to be a pattern for you. So something that wouldn't be good is you buy a share at $100, it goes down to $80, you sell it, so now you took a $20 loss or 20% loss, and so now you buy two more at $80, hoping that it will go back to $100, okay? And now it goes down to $70, and you sell it, and because you bought two shares, now you're at a loss of $20 from buying two shares at $80. It going down $10, you having two shares, that's $20, and then on top of the other $20 that you initially lost from the first move, right? So now you're down $40. Yes, you see how quick that went downhill? Now, I know it may sound confusing. I know it may sound like it's a contradiction. Like, wait, so don't buy more? That's not the case, okay? Cost averaging and taking a loss on a position and doubling down is not the same thing. That is what we call revenge trading. So now you're down $40. And believe it or not, seeing how quick you got down to $40 may trick your brain to thinking you can go up $40 just as quick, when that's not the case. Okay, so it's not just the market going in that down direction that's making you lose $40. It's your decision making that made you lose $40. And so now you might try to double down even more. You might even withdraw money, like I said, from that bill money that you have sitting around, or your mortgage that you have to pay for, that car note that you have to pay for, trying to make it back. And essentially, you end up losing more money. And now you feel like the stock market is not for you. Now you feel like it's rigged, or now you feel like they're taking your money, when that's not the case at all. So what you want to do is you want to make a better decision than you made the last time, and that's always the motto. And once you live by that and you start making better decisions from everyone else or your competition or other retail investors, that is when you start to be on the green side. Okay, so I'm not saying I'm this amazing trader, I'm the best trader in the world, but like the example I gave to someone who would cut their losses and then double down and then probably lose even more money, I would definitely win against that person just off of my strategy alone, regardless of what the stock market is going. Because like I said, I would have bought in at $100, right? We're not psychic, so I don't know it's going to $80, but let's say it went to $80, right? You might think of it as doubling down, but I don't think of it as doubling down. I think of it as buying in at the right increments, right? Taking measures to bring down my cost average. So yes, I would purchase another share at $80, bringing my cost average down to $90. And if it goes down even more, let's say to $70, I will purchase another share at $70, and so on. So that way my cost basis is lowering And once the market relieves itself, because the market has to relieve itself, once it relieves itself and it goes up even just a little bit, I'm up a lot now. And instead of having 1 share, I have 3 shares or I have 4 shares. And that's why it's also important to put in your orders at different increments. Okay, think of them as safety nets. Okay, you don't put your safety net all on one level. That safety net level fails, now you have no safety net, if that makes sense. Right? You want to have safety nets at different levels. And once you start to use this strategy and you realize how much quicker you make a return on it, you will start to proactively chase that strategy to where you're no longer wanting stocks to shoot up for you to buy in them. Now you understand buying at that dip. Now you understand buying at a discounted price, setting your safety nets below so when the market comes plummeting down, doesn't necessarily have to be crashing down. It could just be a soft pullback, right? You're getting it at a discounted price from when you were initially interested in it, and you're riding that wave up. Now, the same goes for securing your funds as well. And we'll also talk about that in another video. Okay, this is not about getting greedy, but you don't want to miss out, and you also want to maximize how much profits you could get to what's under your control. Because like I said, we don't control the stock market, right? But if you want to take some of your gains, let's just say the stock now, let's say you have 4 shares of that company and your cost average is, for the sake of this example, $75. So now you have 4 shares. That's equivalent to as if you bought them at $75. Now you're back at $100. Now it is going up. You don't necessarily have to sell all your shares right then and there. You can set it at different limits. You can set one sell limit at $100. You can set another sell limit at 110, 120, and so forth. So that way you're capitalizing and you're not getting too greedy, right? Because like I said, it may not go all the way up in a straightforward direction. It might have certain pullbacks, but now you could capitalize off of the pullbacks, and you could also make sure that you get your gains and it doesn't come shooting back down and now you didn't sell all of it. Because we often think about a stock going down, us selling it, and essentially taking ourselves out of the position to where we missed out or we lost money, right? But you could also miss out with it going up and coming right back down to those levels. So that is why it is important to set your limits at the appropriate levels and don't revenge trade. If you feel like you're making an emotional decision, then I would hold off on making that decision. You want to make logical decisions. And you might have emotions towards your logical decision. We're human. We are emotional beings. Okay, so not to contradict myself, but understand the difference between, I feel like making money. I feel like buying in right now. What is that based off of? That is based off of emotions. Now you're a gambler. Versus, okay, I seen it come down 20% in the past week. It is at a discounted price from what it was at last week. And like I said, you can't predict the future, right? So that might not be a green move to where you know it's coming back up. But you made a logical decision. You're making a purchase at a discounted price versus what it was at last week. So on the bright side, you got a 20% off sale. Think of it that way. Okay? And if it continues to go more down, buy more. Buy more. Get more shares at discounted prices. Don't put all your eggs in one basket. Make sure at whatever increment that you purchased it at the first time, you stick with that increment. Right? So for example, if you bought 5 shares at once, initially at $100, and it goes down to $80, I would recommend at most 5 shares, 5 more shares at $80. And that is why it is important to have capital to the side. Don't think of it as the capital is just sitting there. It's not making money. It could be in a stock right now. No. What's going to set you apart from everybody else is your ability to deploy more capital when it reaches those lower levels. Even if it went down 10 unexpected times that you thought it was going to go up, you should have enough capital there to where you're able to buy more. And not telling you to buy more either, right? You could also sit it out, wait it out, but that way you are more in control with how much profits you're taking back on. Okay, because it's also perfectly fine to observe it go down and you don't buy more. I recommend you buy more if you believe that this stock has potential and you see a bullish pattern in the near future. Okay, but you don't have to do anything. But one thing I would advise against is just selling and cutting your losses because you feel that way emotionally. Because there's also times to cut your losses as well, but it has to have some type of reasoning behind it, or it should have some type of reasoning behind it. Okay, nothing wrong with stopping the problem, stopping the clock, and cutting your losses if you have to, but don't make it a habit. And that's the main point that I'm trying to get you guys to understand now. Okay, don't make it a habit. Don't sell your stocks and cut yourself short every time the stock goes down. Is it okay to do it once or twice with maybe no meaning at all? Sure. Okay, but you are setting yourself up for failure if that's what you're going to do every time. And that is what you need to get out of the message. Okay, so revenge trading is a no-go. This is not a time to be petty. And revenge trading can also be looked at if you are making money. Okay, let's just say you purchase a stock at $100 and it shoots up to $120. Okay, so now you're up another 20%. Okay, that doesn't mean you double down and you ride the wave up, because that is a very quick way for you to lose all your money. Now you're more in the red than you were in the green because you've doubled down. You've purchased twice as many shares at the 120 level vice the initial 100 level. So you see how that can go wrong? So that's another thing to consider. Okay, you can plan your exit to where you're not necessarily selling all your shares just because you're up, but you can sell some of your shares in increments. And you're also not revenge trading on the upside as well, where you're getting too greedy and you feel like you need to, double your money or triple your money, or things are going well for you. No. So I hope you got something out of that. That is why revenge trading can be so dangerous. Thank you for tuning in. Make sure you like, comment, share, and subscribe so we could continue on this journey.